everyone, this is Carrie. Welcome to our live launch. The price of stainless steel is at a high level, and the sea shipping costs have not been reduced. It is still difficult to book the containers, and this is the situation in the past 2 months. So now many companies have begun to assess this trend and begin to plan the new purchase orders. So as usual, I will talk something about the stainless steel market. With the more than 1 trillion infrastructures built in the United States, taking another major step forward last week. For every 1 billion US invested in infrastructures, AISI estimates that about 50,000 ST of steel and stainless steel will be needed, which would add up to more than 70 million ST of additional steel needed. Asia over is cheaper, but the shipping cost is terrible high. According to understandings, the price gap is getting bigger between the market transactions price and near as was price, and the current domestic demand was much larger than the market price, which caused the steel mills to increase their best price an additional chunk. There is already a shortfall of 40 million tons of steel and stainless steel for 2021 and 2022. Furthermore, the stock market demands also caused the shipments to be extended, and most of the market participants believe the situation will be continuous until the end of this year. And the future market price of stainless steel in the US becomes hard to predict. Expected the short supply situations would be hard to be eased in short terms. Since the LME nickel price came back to high levels and remained stable in the past week, many companies confirmed inquiries from foreign customers have come back to the local markets. However, as the steel price have already gone up, buyers from other countries already showed their considerations in controlling purchase costs in those inquiries. Meanwhile, there was also roadmap in the markets and guesses if China will start collecting stainless steel exports from the first days of September. According to traders, buyers from the US, Japan, and Australia source most acceptance of quotations currently. So nickel price have recently outperformed stainless steel price. The market believes that Chinese stainless steel production cut and higher costs will prevent stainless steel price from falling, given the tight price of nickel ores and NPI. Due to a tight price of nickel plant, stainless steel producers have to turn to nickel briquette. Next one is while Europe and the United States are in the massive growth phase after the COVID-19. China, on the other hand, is trying to crowd out its own markets in order to control the raw materials price and the manufacturer cost, as well as energy shortage and logistics difficulties, and still solving and turnaround in carbon emissions at the same time. In the medium term at least, this should lead to a strengthness of base metals and other commodities. This news is about improved situations for European stainless steel mills. European stainless steel imports are below peak level despite high demands. Lower output in the Chinese steel industry has contributed to this, as have rising freight costs and EU import duties. Last week, China imposed yet more restrictions on domestic steel production next winter to improve air quality. China curbs production has already led to a drop in iron price of nearly 30% since mid-July. In addition, the introduction of a Chinese export tax of 15% to 20% on some steel grades is under discussion in order to meet domestic demand. An increase in euro imports is therefore not expected in the coming months. European stainless steel mills can benefit from this in which of increased margins. And then it is about the shipping problems. 2021 this year is also a challenging year for the shipping and port centers. First, logistics. Chinese ports are nimble cross in past for a week. Logistics and transportation continues to be a defining issue in global chains. Since the beginning of the COVID-19, local outbreaks have repeatedly curbed. China's reactions from the respective governments, as is not the case again in China. The important part of the Ningbo must close for a week due to the corona outbreak in past. This also highlights once again how important it is to plan and work with the right partner. The shippers are in for struggle yet another time, with the market buckets in speculations of liners playing or brand sailing during China Golden Week holidays in early October to extract massive profits. The record high rate of the latest weeks, as can be seen in several global indexes, such as SCFIs, NCFIs, and FBX, are not expected to decrease in the next months. Even though brand sailings close to the Golden Week are a traditional practice to make up for lower demands during the winter months, but this year, the cargo owners expected the liners to maintain the deployment of the entire fleet along transport routes after the COVID-19, owing to the strong demand and elevated rate of sea shipping costs. With the Ningbo terminal shut down, ensuring reversals of slight decrease in market rate in the past few years, an increase in forward bookings on routes to the west coast of the United States. Companies have expected not to let go of these opportunities to bump up the freight rate better out. COVID-19 has hit the shipping supply chains. The global rate of containers and port congestion continues to occur, and port congestion problems continue to worsen. At present, about 400 container ships around the world are stopped in light airport. And the container shipping market is facing the biggest crisis in 65 years since the advent of the container ship. The biggest cause of global ship congestion is the difficult border control measures in different countries under the influence of the COVID-19, as well as the forced shutdowns of many factories, which endangers the smoothness of the entire supply chains and cause the shipping costs higher and higher in China, the United States, and Europe. Some experts point out that the supply chain is difficult to handle the surge in terminal demands, coupled with the old port infrastructures, which has led to the biggest crisis in the transportation industry in 65 years, highlighting the province of insurgent investments in these industries. And these all are the news today.